Hello guys, welcome back to my channel. My name is Matthew and today I'm here again with another video on Canadian Securities Course. So this time I have brought some important questions which would be really helpful for you for clearing the exam. So today I'm bringing some important numericals and some one-liners which would be very beneficial for you. So last time I brought an introduction video on Canadian Security Course where I had discussed all the details about how the exam looks like and the other details like fee structure and examination strategy, preparation time, how to enroll the exam. So if you are planning to take this exam in near future, I would highly recommend you to go and check out that video. So now, without further delay, let's check out the questions which I have prepared for you today. So let me share my screen. So our first question. So the question says, using the table, data in the table, determine the equilibrium price for vacuum cleaners. So for this question, we have three parameters: price, quantity demanded, and quantity supplied. So our equilibrium price is that price where quantity demanded becomes equal to quantity supplied. So let's see our prices. So first price 300, where the demand is equal to 10,500 and supplied is 1,000. So that means there is a gap of 9,500. Now let's see one more option, 400, where the demand is 9,000 and supply is 4,000. Here again, there is a gap of 5,000. Now let's check out 500. So here we can see that both demanded and supplied quantities are almost 6,000. So that means this is our equilibrium price where quantity demanded becomes equal to quantity supplied. Now let's move on to second question. So DEF Bank shares are currently quoted with a bid price of 20.25 and an ask price of 20.27. A client wishes to purchase 1,000 shares without delay. Which type of order would be used in this situation? So here we need to check out three important parameters. First is the bid price. So bid price is the price where all the buyers are standing. So that means if you want to sell something, a stock immediately, it would be the bid price that you would be getting where the highest buyer is standing at 20.25. And if you want to purchase something, you'll have to check the ask price where all the sellers are standing. So you will, if you want to like buy something immediately, you would be getting it at 20.27 where the highest seller is standing. Now, a client wishes to purchase 1,000 shares without delay. That means a client wishes to place a market order to purchase 1,000 shares immediately. So in that case, you will be getting this ask price, which is of 20.27. So for that, the question was which type of order would be used in this situation. So the answer would be the market order. So there are four options which are given here: limit order, stop buy order, market order, and good till cancel order. So the limit order is that order, suppose if the client wishes to buy something at a cheaper price. So here currently for immediate order he is getting 20.27, which is the best price he would be getting because seller with the highest bid is standing at 20.27. So that is the best price if he wants to buy immediately. But suppose if he wants to purchase something at 20. So in that case, he will have to wait for some time till the seller reduces his price to 20.20. So that would be his limit order. Stop buy order is something which is used to decrease your stock, like loss. So if you want to, if you have sold something for $30, and if you want to limit your dollars to $2, in that case you would put a stop buy order, which will help you to limit your loss to $2 at 32. Now we have market order, which we have already discussed. If we want to purchase or sell something sudden at immediately, then we will place the market order. Then good till cancel order. And this is the order which stays in the system for 90 days until you cancel it. If you don't cancel it, it will be active till 90 days till your target is achieved. Now next question. So here we have XYZ stock is currently quoted at 80.40 and 80.42 ask is in the price. Maureen wants to sell 1,000 shares, but only if she can get 80.42 or a higher price. What type of order should she use? So here Maureen is the seller and all the buyers are standing at this bid price, that is of 80.42. So if she wants to sell immediately, she would get 80.40. But since the question says she wants to sell at 80.42, which is a higher price, she will have to wait. And for that, she will have to place a limit order, which is our first option. Then we have other options: market order, stop buy order, good till or cancelled order, which are not relevant for this question. Now let's move on to our next question. So how frequently does the government of Canada conducts auction for its 30-year benchmark bonds? So for 30-year benchmark bonds, the auction is conducted semi-annually. And for all other bonds like 2-year, 5-year, and 10-year, the bonds are auctioned semi-quarterly. Next question. Here we have a bond and its quotes are given here at the side. So the question says a 10,000 par value semi-annual bond has the following information. How much interest will be paid on January 15 of each year? So the condition is given that the bond is semi-annual. That means payment will be done twice a year. So if January 15 is the payment date of first installment, then the second would be almost July 15 after 6 months. So the conditions are given. The issuing company is DAR company. Coupon rate is 5.65, which is annual coupon rate. So for 10,000, annual interest would be 565. Maturity days is January 15 at some future date. Bid price and ask price and current yield, which will be getting, which is this bond giving at the present time. So let's see the option. First is 565, B 541, and C 282, and D 270.50. So the answer would be C 282.50, because as we discussed, 5.65 is the coupon rate, which is for the annual payment, but it is divided into two as it is given in two installment, January 15 and July 15. So January 15 would be half of 565, that is 282.50. Now let's move on to next question. So this is the basic stock quote, which you can find on stock exchanges. So the 52-week high for a particular stock, GOG common share, which is listed on a stock exchange, let's say TMX. So the 52-week high is uh, 52 high is 35.45. And 52-week low is 23.78. So 52-week high, that means in a year it has hit a high of 35.45 and it has hit a low of 23.78. At the same time, sorry. Yeah, at the same time, the stock dividend is GOG stocks. So every stock is listed with a symbols. For example, Apple will be listed with a symbol of APL. For example, let's say dividend. So it has given no dividend. And days high. So today's high, for example, is 29.97 and days low is 24.98. Closing price in the previous session was 28.56, and changes how much change the current price has from the previous low, or sorry, previous closing. And this is the volume of shares which are currently traded for this share. Now, next question. Stephen holds a 5,000 ABC convertible bond, which allows him to exchange each 1,000 of face value for 50 ABC common shares. With ABC stock now trading at 24 per share, what should Stephen do? So here there are again three conditions which we should take in account. First is 5,000 ABC convertible bond. That means these bonds can be converted into shares. That is our first condition. Second condition is 1,000 of face value for 50 ABC common shares. That means 1,000 shares can be converted into 50 shares. That means 5,000 can be converted into 50 into 5, 250 shares, as 1,000 is 5 times 5,000 ABC convertible shares. Now we have another condition that ABC stock is now trading at 24. So the question asks, what should Stephen do? So two things. First thing is the bond itself, it is giving 5,000. But if we convert those bonds into shares, we will be getting almost uh, 24 into 250, that is 6,000. So If the client Stephen converts his 5,000 convertible bonds into shares, he will be getting a profit of 1,000 because the stock value is more than the bond value. So that is our answer. Convert the bond into 250 ABC shares valued at 6,000. Now, the question says the government of Canada is issuing 1 billion in new fixed coupon bonds. The table below shows competitive bids for several security dealers. Which bidders will have their bids accepted? So the question says that the government of Canada is issuing 1 billion worth of new fixed coupon bonds. Now, who all is getting like a say in these bonds? So we have competitive bids here, 2.890. So everybody has given their competitive bid. So the reasoning behind getting these bonds are so whoever pays, like whoever is issuing lowest bid, the government of Canada will have to pay the lowest interest to them. So, and for in short, they have to make less payments to the lowest bidder. So the sequence will be like that. Whoever has the lowest bid, that person will be getting the bonds first, and then in an increasing manner, these bonds will be distributed till the time 1 billion is reached. So here we can see the lowest bid is at 2.860. Then we have 2.8750. That means 2.860 bid, the fourth number. That guy is gonna get 280 million worth bonds, and then the second person with the lowest bid 2.875, this person is gonna get 220. Then the third lowest bid at 2.880, 230 million. So this sequence will be followed throughout the time till 1 billion of bonds are reached. So everyone who has paid the lowest bid will be given those bonds. Next question. So the question says in a corporation who typically holds the authority to decide whether dividends will be paid to shares. So who decides whether the dividend should be paid or not? So the options are vice president, president, board of directors, chairman of the board. So generally, board of directors are the ones who have a say on dividends. So they are the ones who decide whether the profit should be distributed to the clients, the shareholders, or should it be retained for the expansion of its operation. Now let's move on to next question. So which metric estimates the expected percentage change in a bond's price if interest rate increases by 1%? So the answer for this would be duration. So duration is the sensitivity of a bond with respect to the change in its price. So specifically, it approximates the percentage change in the bond's price for 1% change in interest rates. So C duration will be our answer. Now let's move on to next question. An investor bought a Nova Scotia Power INC bond with a 5.75 coupon rate maturing on March 15 some date. When are the coupons payment typically made? So Nova Scotia Power bonds were bought with a 5 were bought maturing on this date. When are the coupons payment typically made? So typically a bond is paid like semi-annually. So on March 15 and September 15 every year, the payments will be made. So the logic is same. If it is not given whether it is annual or semi-annual, we have to typically assume that the payment will be made semi-annually until it is specified that the payment will be made annually. So DEF Inc. has decided to increase its financial leverage. How will this likely be reflected on its financial statement? So the question says that DEF is taking some financial leverage. That means it is taking debt from a particular financial institution to increase its profit. So if this leverage, this debt which is taken, if it amounts to profits, then an increase in the for the company. If this leverage, if wherever the amount is put, if the venture it results in losses, then in that case, whatever leverage has taken will be unfruitful and will be producing negative gains. So, as per the question, how will this likely be reflected on its financial statements? So, the answer would be an increase in reported debt levels. So, leverage is taken by debt, so the debt levels would be increased. Now the question says which type of investment order can be used to limit a loss for an existing long position? So to limit a loss for a long position, a client has to place a stop loss order. So stop loss order would be, so an on-stop sell order is an order to sell a security. Since the client is already having a is having the shares, in that case, to limit the loss, that client has to place the stop loss order, which is to sell the order. Now, sell the stock. Now, moving on to next question. At the close of the day, XYZ Bank reviews its position in the links payment system and notes 40 million owed to other financial institution and 65 million expected in incoming payments. How much cash does XYZ have available to lend for it? Need to borrow? Will it need to borrow? So we can see that there are receipts of 65 million, which are expected incoming payments, and it has 40 millions which it owes to another other institutions. So in this case, it will have almost 25 million to lend in this case. So like answer D says, has 25 million available to lend. Next question. So Anna owns shares of XYZ purchased at 330 each. She instructs her broker to sell her shares if the stock prices reaches 36 or more within the next 30 days. What type of order is this? So basically, Anna is owning the shares and she wants to book the profit if the stock moves in the positive direction, that is 36. So in that case, the client will have to place a sell order, and sell order will be placed with a condition of good till cancel order. So our answer would be good till cancel order, since it has to stay in existence for next 30 days, because if it is not a day order which will be cancelled in the day, or so to remain in the system for some time, it has to be a good till cancel order. Next question says, which of the following statements accurately describe features of margin accounts? So first condition is margin account calls must be settled promptly. So that is true, because whenever you get a margin call, you have to settle that position. You have to provide adequate funds. Otherwise, your position will be squared out. That means your position will be sold in the amount which is turning into your losses. Using margin reduces investment risk. So that is a false statement, because margin it actually adds leverage to your position, so which have the effect of high risk and high profit. So it is not reducing risk. In fact, it is increasing your risk. The dealer requires the client's permission before selling any securities from the account. So that is false statement, because once you are taking the margin, you have already signed those terms and condition that the dealer can sell the stocks if the client is responsible for paying interest. So fourth statement is true, because client is paying the interest on whatever loan that is being made by the dealer. So next question says PSM Inc. authorized 50 million shares during its IPO. It sold 20 million shares. A private pension fund bought 80 million of these shares and still holds them. A few years later, the company repurchased 5 million shares. What is the current public float? So, company came up with an IPO of 20 million shares. That means 20 millions they are issuing to the public. Now, out of this 28 millions were bought. That means a private pension bought 8 million. So 20 minus 8, 12 million are left for the public float. And now out of 20, 12, 5 are also again repurchased by the company. That means 12 minus 5, that is 7 million are left as public float for now. So Sherry owns one DCC February 25 put option priced at 2.55. The current market price of DCC share is 23.75. What are the intrinsic value and time value for this put option? So for put option, for example, if a stock is trading at 23.75, so whatever strike price which is above that 23.75, those strike prices are called in the money. And the difference between so now the second condition is the price options price is 2.55. So whatever amount which is above 23.75, that is the amount by which the strike price is in the money, that is called the intrinsic value. And when we like subtract this intrinsic value from options price, it gives us the time value. So options price is 2.55, and DCC share intrinsic value was 1.25. So 1.25, 2.55 minus 1.25, the answer is 1.30, which is the time value of the stock of the option. Now the next question, what is one of the main roles of financial intermediary? So financial intermediary basically acts as an institution which takes money from the like from the ones who have in excess and gives it to the ones who are in need of money. So that is the main function of financial intermediaries. So option C says help transfer capital from those who supply it to those who need it. So that is our answer. Now let's move on to next question. So question says what does the time value portion of an options premium reflect? So time value portion is that price is the actual price of a stock. So actual price means when we subtract the intrinsic value from an option premium, what we are left with is the time value. So that time value will remain until expiry, and slowly this time value keeps on decreasing as the expiry increases x in years. Now we have a question. An investor holds a forward contract on Canadian dollars with an underlying amount of 1 million CAD and has realized a profit of 50,000. What is the corresponding loss for the seller of this forward contract? So, Canadian dollars with an underlying amount of 1 million CAD and has realized. So, someone who has realized a profit of 50,000 in forward contract, the other counterparty is at the loss of the same amount, that is of 50,000. So, for loss for the seller would be 50,000. The Bank of Canada has set the overnight target rate at 1.50. Under what circumstances would the bank typically initiate an overnight repurchase operation? From the target which is set for the overnight rate, and the Bank of Canada it intervenes so that that band is not not exceeded or not nor does the interest rate goes beyond below that particular rate. For example, for repo rate overnight rate, the band is 1.25 to 1.50. So suppose a financial institution is lending at 1.75, Bank of Canada will intervene and start lending at 1.50. So this will put a downward pressure on the interest rate. In the same manner, suppose if the interest rates are going down. Suppose the interest rate one went at 1.210 and the lower band was 1.25. So again, Bank of Canada will intervene and start borrowing at 1.25. So which will create an upward pressure and the interest rate will fall within the range of 1.25 to 1.50. Moving on to next question. A year ago, Kerry purchased 1,000 shares of ZLT Corp at 40 per share. The shares are now valued at 51. She plans to sell them for at least 48 each in 14 months to fund a sabbatical trip, concerned that the share price might dip below her target. What derivative strategy should she consider? So generally, the options, standard equity options are typically for existence for 9 months. So for 14 months, so Carrie would have to purchase a 10 ZLT long-term equity anticipation securities, that is LEAPS put option, which gives the holder of the option, Carrie, the right to sell the stock for even if the 9-month duration is exceeded. So she would go for this ZLT long-term equity anticipation LEAPS option. Now, moving on to next question, which statement currently describes accrued interest? So, accrued interest is the interest which is accumulated for a bondholder who is the purchaser of the bond. So, as we discussed in previous questions, that most bonds they are making semi-annual payments. For example, let's say one bond makes a payment at 31st December, the other at 31st May. So on 31st June, in that case, suppose the bond has already made payment to the purchaser on 31st December, next payment was on 31st June, but the purchaser plans to sell it on 1st of May to another investor who wants to purchase that bond. So in that case, whatever interest has been accrued from 1 January to 31st April, that much interest will be given to bond purchaser, the original investor of the bond, by the one who is actually buying from the original investors. So the seller will get the interest which has been accrued from 1st April to 31st April, 1st January to 31st April by the purchaser of the second purchaser of the bond. So that is the accrued interest. So let's the seller pays the accrued interest. So the condition is B1 and 3. It is calculated based on bonds coupon rate, so that is first condition, and the buyer compensates the seller for the accrued. And so whoever is buying now from the original purchaser will compensate for that whatever interest was accrued to the seller of the bond. Now, an investment advisor has acquired phone numbers for cold households in a wealthy demographics and plans to cold call each one to promote his service. Which regulation governs the advisors' telemarketing activities? So, in Canada, the telemarketing activities are governed by CRTC, that is Canadian Radio and Television Commission. So, in case if you want to make a phone call to anyone, that if an individual has registered on for this do not call list, you cannot call them except the businesses. Businesses you can call them anytime. So, so do not call list has to be followed before making a telemarketing call to an individual. Now we have Leila who has shorted 1,000 shares of DEF Limited at 19 each and wants to place an order to limit her potential losses if the stock price rises. Which type of order should she use to best protect herself? So Leela here is the seller of 1,000 shares of DEF at 19 and wants to place an order to limit. So in that case, Leela is going to place stop buy order. So we have D option, stop buy order. So for seller, if a seller wants to restricts its his or her losses, in that case, that client has to place a stop buy order to limit one's losses. Now let's move on to what is the key distinction between futures contract and forward contracts. So the basic difference is futures contract is completely standardized and forward contracts, they are not standardized. So they are the over-the-counter contracts. So the key distinctions, the answer would be future contracts are traded on exchanges, whereas forward contracts are traded over the counter. More details can be you can get from here. Which activities are investors allowed to perform in margin accounts? So we have option maintain long position, borrow funds to engage in short selling, maintain short positions, open margin account with any investment dealer. So the answer would be to maintain long positions and to maintain short position. So 1 and 3 would be the answer. Now, next question. In a given fiscal year, a government collects 22 billion in revenue, spends 28 billion and has 4 billion in existing debt reaching maturity. Ignoring other factors, how much debt must the government issue to meet its obligation? So here, government has a spending of 10 billion, 28 billion, and also 4 million are its previous debts and has a collection of only 22 billion. So 22 billion is less than its spending and its existing debt, which is of 32 billion. So government has to have 10 billion to meet its obligation. Now, what is the term for unethical behavior where a broker executes trade for their own account ahead of placing identical trades on behalf of a client? So this practice is called front running. Front running is when a dealer or investor representative takes advantage of client's knowledge and places the same order on his account based on the advanced knowledge of his or her clients. Underwriting is a procedure where a financial intermediary like takes the onus of the IPO, buys everything, takes the risk of placing it to the customers, and they do the pricing, placement, and everything. That is called the underwriting. Here again, underwriting could be partial or whole, where everything they take into account, they become the main principal and do everything for the IPO. Partial, where they don't take the responsibility of like taking the risk. If it is not sold, it won't be coming on to the underwriter. Now, Musa is looking to purchase a bond with a maturity of 5 years. Which category best describes this bond term? So, bond terms, so 1 to 4, below 5 years, they are short-term bond, medium term or 5 to 10 years, and above 10 are long-term. So here the maturity is 5 years, which comes under medium-term bonds. So answer is medium term. Now, what is the duration of the mandatory internal training program that new investment advisor must finish before they are authorized to interact directly with clients? So the answer is 90 days. So here again, to become an investment dealer, you have to first clear investment representative. You have to clear the CPH exam and the CSC exam, and then you are under a supervision of 90 days where you don't do anything, don't do any selling directly. You work for a as a assistant, and then within 30 months you have to clear this WME essential program to act as a full service representative. An investor holds 4,000 shares in a company with an adjusted cost base of 10 per share. The company announces a 2-for-1 stock split. What is the total ACB of investor shares following the split? So stock split is a scenario in which one share is broken into 1 to 5, whatever split ratio is, and consolidation is a process in which reverse stock split, which is consolidation, which where two or more stocks merge to become one. So here the company is announcing a 2-for-1 stock split. So two stocks are going to be splitted for one. So 4,000 stocks will become 8,000. In the same manner, the cost a basis would become by half. So 10 per share would become 5 per share, but the overall impact will be null because 40 into 10 is equal to 40,000 for the investor, and 8,000 into 5, 40,000 is the same value for the investor. So for investor, there will be no as such change in the cash value of the stocks. Now Eugene purchased 1,000 shares of ABC on margin and will be away for 3 months to protect himself from significant losses while he's gone. What type of order should he place? So to reduce the losses, Eugene is gonna place top sell order with GTC condition, that is good till cancel condition, so that it could remain in existence for next coming 3 months, that is 90 days. Now, if short-term government securities are offering a nominal interest rate of 1.8 and annual inflation rate is 2.3%, what is the real rate of return? So, real rate of return is inflation rate minus the nominal rate. So, inflation rate is 2.3. Real return is the opposite. Nominal rate minus inflation rate. Nominal rate is 1.8, inflation is 2.3. So, that means actually we are having a negative return of 0.50%. The current quote for QRS common shares shows a bid price of 45 and an ask price of 45.50. Myrna places an order to buy 5,000 shares at the best price available. What type of order did she submit? So Myrna places an order to buy 500 shares at the best price available. Best price is market order always, and market order she will get this for ask price where all the sellers are standing 45.50. Now Harif wants to invest 10,000 shares in a tax efficient way, which he does not require current income and is comfortable with some risk. Which type of security would be most suitable for him? So the most efficient way is in common shares because debentures and government bonds and floating, they all are like taxed at the actual tax rate of the client, but common shares, they are actually taxed at 50%. So common shares would be the most tax efficient since he doesn't want any regular income. Common shares would be the best choice. Now GHICO announces a reverse stock split. How will this affect the common cash balance? So reverse stock split, that means 2 or 3 or 5 stocks, they are merging into one. But as discussed in the previous question, neither splitting nor reversing has any cash impact on investor. So cash balance will remain unchanged. Which of the following is considered a structured financial product? So structured product are more complex investment vehicles where two or more investment mediums are merged to provide better returns. So in case of this, PPN would be a structured product. So, giving an example, let's say you are investing 10,000, $100 in a PPN. So, how PPN is structured is that it will invest 95 in a zero coupon bond. That means 95 will assure 100 on redemption. That means your principal is protected, and the remaining $5 will be invested in a call option. So, even if call option expires worthless, your principal is protected by PPN, and in case if it gives out better returns, that will be your plus benefit, bonus benefit. Jerry, who has limited investing experience, recently inherited 100,000 and wants to invest the entire amount. Which type of investment firm would best suit his needs? So, since Gary has no limited investment experience, in that case, it would be better if an full service retail firm gives him advice on where to put this 100 based on his KYC, his investment knowledge, his investment needs. So a full service retail firm will take care of it. What term refers to the process by which a private company offers its share to the public for the first time? Its initial public offering, the first time that it comes for offering its shares, and after that, in case if investors wants to exchange or sell their shares, it is done between the investors themselves, and it is done on the secondary market, which are your stock exchanges. BC Limited, an investment dealer, is the exclusive underwriter for a 300 million share offering by MIR Limited. BC Limited has agreed to act as a principal for this issue. What obligation does DC Limited have towards MIR in this role? So, as I was discussing in the previous questions, DC Limited is the underwriter here, and he is acting as a principal. That means all the 300 would be in custody of the underwriter, which is BC Limited. So he has the responsibility of selling the entire issue. In case there is a loss, it would be loss for BC Limited, not the MIR, because the obligation was passed on from MIR to BC Limited. Otherwise, MIR would have placed it directly in the IPO, and if it was unsold, it was the loss of MIR. So the answer says BC Limited will buy the entire issue from MIR and take on the risk of reselling it. Now, how does an overall enhancement in workforce education and training typically impacts the country's gross domestic product? So our GDP is affected when the workforce is educated. They will acquire better skills, and better skills will return into better output, better productivity, which will in turn increase the GDP of a country. So the answer would be an increase in GDP. Which action is most likely to lead to an increase in companies' retained earning in upcoming years? So, if a company decides not to distribute their profit as dividends, it can retain its profit, and this decision is taken by the board of directors. So, if the board decides to reduce the dividend payout, they can increase the retained earnings in upcoming years to increase their operation. Why do corporations most commonly issue long-term debt instruments? So long-term debt instruments are issued like Government of Canada, it issues 30-year bonds. So these are done for the purpose of like infrastructure development. So all those purposes which are long-term for housing development. So for long-term, all the long-term long-term situations, long-term investments for government, they issue long-term debt. So this is the reason. So answer would be to raise capital for expansion initiatives. Now coming on to next question, what is the common purpose for which an investor might refer to a bond index? So bond index, it tells you the performance of overall bond. So like stock has its stock index, in the same manner bond has its bond index. So to assess how well a bond portfolio manager is performing, so that would be our answer. Now let's move on to next question. Dale is interested in monitoring the performance of of major US industrial companies with large capital market capitalization. Which index would best serve this purpose? So S&P 500 is the index which has all the major 500 companies of the stock exchange in US. So this will act as a barometer in assessing how the market is performing or how the companies are performing on a bigger scale. So that was all from my side for this set of questions. So last time I got a really good response. Everyone was interested in giving CSC exam, was curious about the notes. So in case if you want any assistance, you can reach out to me directly on my email, which is there on my channel. You'll have to find it. And then in case if you want any assistance, just write it to me, just comment on my video. And if you want more parts of these important questions, I can come out with more videos. So all I need is your support, likes, and subscriptions. I will come up with more important details and questions for you. So that was all from my side for today. Thank you and have a good day. Bye.